All right. Well, thank you everybody for coming today. With my partner Kevin Bell. My name is Brent Laird, and we are CPAs at Kernutt Stokes LLP down here in Eugene, Oregon. But do a lot of work for people all across the country. Today we're going to be talking about cryptocurrency on our monthly question and answer series. So excited to talk about it. For those listening at home, thanks for listening in. For those questions, feel free to drop those in our chat. We've got a little chat feature that you can drop them in, or if you want to raise your hand or just kind of throw them at us, that's what we're here to do today. Quick disclaimer, this isn't tax advice, don't rely on it. If you want, privatized consulting, get a hold of us afterwards. This is more of general questions, general talk. So don't sue us for what we say. Disclosures, disclaimers, all that stuff.
And this is not financial advice.
Yeah, also not financial advice. I am the CFP, but this is not financial advice in the setting. So with that all kind of out of the way, thank you guys for coming, and we'll just start jumping into things. So
go ahead, Brent.
So I think kind of, what rooted this is there's a lot of questions that we get, a lot of call-in questions. Hey, this year I sold a bunch of cryptocurrency, what's the tax ramifications of that? And there's a lot of branches that go out of it. So, I think we'll kind of, most of the questions we've been getting on emails here and our messages has been around, hey, I just sold, Bitcoin last year, I made 70 grand. What does that mean to me? And so I think I'll just kind of let Kevin jump off into kind of that question, and might even have some slides to kind of go through a little bit on just specific ones there.
Well, thanks, Brent. And maybe before I jump into that, I just want to say I'm really excited about today's topic. I'll admit I have not been in the crypto space for since the beginning. It's since last year I got into it, and I've learned a lot. And Brent and I've kind of taken this journey together, I might say, along with other things in the Web3 arena and NFTs and such. And it's been really interesting to learn all this stuff. And not only that, but thinking about it from the U.S. tax perspective, as CPAs, that's what we do. We think about that stuff. And what's interesting is that the IRS hasn't provided a lot of guidance in this area. One of the only pieces of guidance that they've provided so far is saying, hey, crypto is property. Essentially, it's property that would qualify for capital gain treatment. So that's it. That's about it. So what we have is existing tax law that we have to rely upon to figure out how all this stuff is taxable and whether it is taxable, whether it's not taxable. So it's quite it's an enjoyable thing for a tax nerd like myself, and I think for Brent. So we'll jump right into this. One of the things I think that needs to be set up front with this with cryptocurrency and everything is that for U.S. tax purposes, all transactions have to be translated into the U.S. dollar. Okay, we have a lot of different crypto coins out there. They all have their own values, but at the end of the day, we got to translate this stuff all back to the U.S. dollar and figure out whether or not there was a gain or loss at the U.S. dollar level. So we'll go through some examples. And I want to say, Brent's going to go into a little bit later some of the specific terminology and such about dealing in this space and the different types of transactions out there. But from a big picture perspective, what I've learned and what I've gleaned from my time in this area and studying this is that essentially everything is potentially a taxable transaction, except if you buy and hold. If you just buy and hold, generally that's not going to be a taxable transaction, but just about everything else is. That's of course a very broad paint of the brush, but think about it that way. So I do want to just share a couple of examples, just kind of, I guess, to whet the appetite and to get some, let me find it, just get some, foundation underneath us. So I'm going to share this real quickly. I can get to go. So in terms of Brent's specific question, how he says, hey, we get some calls, say, hey, I bought this and sold this and I made some money. So I'm just going to I have three brief examples real quick, kind of the big picture of what the types of transactions there are. So there's you know, this is example. Sorry, example one. I buy one Bitcoin for $50,000. It goes up in value to $60,000, and that's why I sell. Well, I have a $10,000 gain. Pretty simple, pretty straightforward. It's going to be long-term or short-term capital gain depending on my holding period. If I held it for a year or more, it'll be a long-term capital gain. You get the favorable tax rates, 20% or 0, 15, or 20%. It would also be subject to the net investment income tax if your income was sufficiently high to fall into that tax. So example number two, another common example is, hey, I bought one Bitcoin for $50,000 2 years ago, and all I did was hold it. And now I really think ETH is going to take off, so I'm going to trade my one Bitcoin for 10 ETH, and the 10 ETH are valued at $70,000. So at this case, even though it's a trade, and people might think, well, I'm not trading back into the US dollar, I'm trading straight into ETH, that it's not a taxable transaction. Well, under US tax law, basically what we have is that, hey, this is a taxable transaction. The like kind exchange rules do not apply. And so we have a $20,000 long-term capital gain. To that said, you now own 10 ETH. Your basis in that 10 ETH is going to be $70,000. Okay, so that's something to keep in mind. Now, if you were to go and turn around and sell that ETH 2 days later for $70,000, basically you would have no gain or loss. So the next type of transaction that we've seen, and it's coming out there, like, hey, I buy 10 ETH, $50,000 about 2 years ago. You know what? I've decided I want to get into NFTs, the Bored Ape Yacht Club. For those who know about that, that's pretty popular, one of the more expensive NFTs out there. And the NFT is non-fungible token. It's digital art for the most part. Also can be smart contracts. And so for 10 ETH, so hey, I bought it for 10 ETH. That 10 ETH is worth $200,000. Well, I'm trading the ETH for the NFT. And the NFT, I'm buying it for essentially 10 ETH, which is $200,000. So I have a long-term capital gain at this point of $150,000. So again, we're buying something. We're also recognizing income at the same time as we buy this. And what's something to think about as taxpayers do these transactions is that where is the cash going to come from to pay the taxes on this $150,000 long-term capital gain? So that's something. It's an issue that people really need to be concerned, think about when they work through this. What I've seen and talking to others, that a lot of people will do, a number of people will do a number of transactions in the crypto space without at the same time understanding that they're going to have these taxable gains at the end of the year, and they need to put money aside for that. So again, these are just some of the 3 common examples. There's many other examples out there in terms of what the capital gains are on this or the impact on these transactions. So So those are the examples. Go ahead, Brent.
And I think just to point out there that, in order to get long-term rates, you got to hold it for over a year. And, a lot of times anyone in the crypto world, they could be making day trading transactions. It could be short-term holds. So, a lot of people get caught up in getting to long-term, or, they talk about capital gains. Well, if they're short-term capital gains, if you're doing it less than a year, it's really just ordinary income. There's no special rate on that piece. It's just more incremental income at whatever your rate is that you've got going on for your personal tax picture. So, we talk about some of the long-term classifications that we'll probably get into later with NFTs. It only matters if you hold it for a year if it's going to be considered long-term. But one of the things to watch out for, and I think of trading cryptocurrencies very similar to trading stocks. I think the rules are very similar. The only difference, there's a few slight differences, but just one thing I would point out is, sometimes when you lose money, that's a capital loss. You can only use capital losses against so much of your other income, up to $3,000. So If you have one year where you have a lot of income, and then the next year you have a lot of losses, you can have some pretty detrimental tax impacts. So there is a lot of tax loss harvesting that you can do with these stocks, with these cryptocurrencies, because the rules are slightly different than for stocks. Wash sales in particular are one of those things that come into mind, where traditionally you can't sell a stock at a loss and buy right back in within 30 days. They'll disallow that loss. They'll just add it to your basis in that next position. Crypto, it's all realized right away. You buy it right back in. So there's a few different timing mechanisms you can do where you can take a loss real quick and buy back in, where you can't do in the traditional stock market. So, but I mean, it's important to realize that capital losses can't always be used right away too. So just throwing that out there.
I want to jump in there regarding the wash sale rules. Some people might have heard that, hey, those wash sale rules were going away. And they were actually on the docket to go away. They were included in that in Biden's Back Better American plan. And essentially that got, we'll put it, shelved at the end of the year in the Senate. So they were looking at it, they were looking at taking it away, but it ultimately just didn't happen because that got shelved and didn't get moved forward. So I think another thing to throw in terms of very similar to the stock transactions, I'll throw this out there, is the concept of high in, first out concept. And that is basically you are, when you are selling your crypto, your currencies, you're specifically identifying the highest basis tokens that you're selling, the highest basis coins that you're selling, in order to again keep those gains down, assuming you have gains involved in there. It could also increase your losses if you were trying to tax harvest. So the thing with that makes it very, very difficult is you have to have meticulous records. There's a lot of record keeping that has to go along, and you have to look at it on a transaction by transaction basis and such. If you think about current stocks, when you sell stocks, it's usually first in, first out. And the brokerage houses will take care of that for you. Whereas with crypto, you really don't have anybody else doing it. So you got to be on your toes in terms of the record keeping on that, the first in, first out method, and specifically identify which coins you're selling.
But I think, to your point, cryptocurrencies are a lot like trading stocks, with a few differentiations that they're not securities, and because they're not term securities, that's why they have those differentiations. They're, we've kind of talked, we believe they're capital assets. We believe they're effectively kind of intangibles in a way. But that's kind of what that piece is that makes them a little different. Yeah. Talking about reporting isn't very exciting, but I think for a lot of people that have, we do get a lot of questions about, like, hey, how do I compile my data? They're in stock portfolios, you get a 1099 at the end of the year that shows you all that stuff. Are there really any good solutions out there at this point, Kevin, in your mind?
There are a few others. Yeah, there's a few. I have never used them, we'll put them this way, but there are a few solutions out there, third parties, that will accumulate the data for you. You'll have to connect your wallets to them to have them download the data and such, and they'll put it into a manageable format for you. So there are some solutions out there. There's not one that I can recommend over the other just because I haven't used them, but there are some solutions.
I'd caution people with wallets to be very careful about what they connect into. There is a lot of fraud in the crypto world, and you want to be really careful. Zen Ledger is one I hear quite a bit that people use. But the problem with crypto is there's just not a lot of great reporting out there, and that's an issue. And I think we'll see more standardized reporting going forward, but with so many decentralized exchanges, and I wouldn't even get into NFTs yet. You're really into some spots there. So,
hey Brent, we got a question from our friend. Yeah. I'll let you tackle this one because I know this is specifically something Brent does. What are the definition of
Let's
the?
see, we've got a question. These are the best ones, so keep these coming, guys. We appreciate them. Question is, I've got algo. I received a 4% return on it, paid in the form of additional algo units. Is this taxable as interest income, or is this just a dilution of the cost per unit? Oh, that's an interesting question. So it sounds like what you're doing is staking. I think of staking as kind of like buying a CD. For those that are familiar with bank terminology, certificate of deposit, you buy it, it gets locked up, and it pays interest, over a fixed period of time. And so if it's that kind of situation where you have it staked and they're paying you out over time, I would say, yeah, you're getting interest income effectively, and it would be taxed at the fair market value of what that US dollar equivalent for that currency would be at that time. So to the point you're getting additional algo units, I would say that's interest income. The basis would be what that US dollar equivalent is at that time, and you'd be picking up that as interest income going forward. So that is how I would view it, Martin. It's a great question. Staking is something you see quite a bit. I know apps like crypto.com have it built in, where others have it on different wallets where you can stake. And in my mind, it's just interest income is what it really is. But I think to the extent that you're going to buy and hold something and you believe in that product, staking makes a ton of sense because they're just going to pay you to stay in it longer. So might as well.
Yeah. One of the things that I will add in terms of just going back to the topic you were talking about in terms of reporting of the various transactions. So part of the infrastructure bill, if you remember, there was middle of last year, Biden came up with his proposal for this infrastructure bill. The Senate and the House agreed that they would separate that bill into one smaller bill and one bigger bill. In the smaller bill that had passed, there actually was some law that there was some additional regulations that Congress agreed upon that the exchanges such as Robinhood and Coinbase and those kind of exchanges would now be considered brokers. And this is important because beginning in 2023, they will have to start reporting the various transactions for their clients on these crypto transactions. So beginning in 2023, it should become much easier in terms of reporting this. Now, there are a whole lot of different questions that come along with that. And so, but it should be getting easier. For those who are familiar, Brent, do you want to talk about a little bit about the difference between centralized and decentralized exchange? Because this kind of reporting can be potentially impacted by these different types of exchanges.
I probably won't nail this definition for the crypto people that are listening, but I think of centralized more as kind of mainstream, more of your Coinbases, your crypto.coms, Binances, more of the publicly regulated exchanges where people can buy and sell and transact easily. Where the decentralized stuff is where you're going to have to get a wallet and go out and hop onto a third-party exchange to get, to be able to exchange currencies for currencies. You think of a Uniswap or a Pancake Swap or a place where you have to go out and physically connect your wallet to those additional places. That's more of a decentralized exchange. And I think the question is, how will those decentralized exchanges report things, because they're not actually taking customer information, they're just dealing with wallets. That's it. Once again, I think puts the onus on the taxpayer quite a bit to pick that up, because I don't really know how some of this just exchange websites are going to work effectively. They don't have the customer's information, they just have wallets. And so the reporting and tracking on this stuff is light years behind kind of where the stock market and traditional investment vehicles are. And so I think people are just going to keep really good records, at least for a few years, until it gets turned around. And part of that is attractive to people because they don't want to be centralized. There's that decentralized aspect that people like about cryptocurrencies and some of these other investments. But it does make it really hard to get the information together.
Yeah. From my experience, I've been using Coinbase. I don't transact as much as Brent does, but Coinbase doesn't do a bad job of being able to go back and find historical information. At least from my perspective, I've been able to find it fairly easily. just kind of a different, some additional comments in terms of the centralized, decentralized. The centralized exchanges have the requirement of know your client, and so they have to verify who you are. Whereas decentralized, they don't. Centralized exchanges also are generally taking custody of some sort of your coins, or holding the coins for you, or the tokens. Whereas this decentralized, they're not. So, but again, the point of that is that it's supposed to be getting caught up in terms of reporting. It's supposed to be moving forward, and it's supposed to be getting easier, I would say. And I would say Congress passed this not necessarily for the taxpayers in mind, but more for the IRS, so that they could track who has income and who doesn't, so that they can properly apply the appropriate taxes to them. So, yeah.
So I'm going to go ahead and kind of throw out one of my tax myths or tax questions that we get, and I'll just I was getting my hair cut a couple months ago, and I think this is kind of one of the maybe the expectation that people that don't necessarily understand that I've got my barber's telling me, he's like, yeah, no, I've been trading cryptocurrencies every day. It's been great. He's making a bunch of money at it. I'm like, hey, that's happy for you. That's awesome. That's what you want it to go up, not down, right? And he's like, but that's not taxable until I pull it out. And I'm like, no, that's not how it works. I mean, that's like how an IRA works. But every time you're transacting, every time you sell, you're creating a taxable event. Every time you're swapping from one currency to another, you're creating a taxable event. And so, you're kind of restarting your clock, you're restarting your holding period, all those different things that you're doing. So, don't think because something's not denominated in U.S. currency doesn't mean that you don't have an income realization event. I think even a buy can create a taxable event. So I would just caution people to be kind of weary of the fact that it's like, there's probably work to do if you're an active trader, which hopefully you've got a reporting system like Coinbase or Ledger or something figured out. But if not, we should probably talk about some of that stuff.
There's a great question in the chat about, at what point do we want to start paying attention to crypto tax issues and such? Well, if you're doing anything in that area, what we want to do is look what you're doing, because a couple of years ago, the IRS realized that there were a number of individuals that are dabbling in the space or investing in the space, and they were not reporting their income. And so the IRS said, well, we're going to add a question to the 1040, your individual tax return. And there's some specific language about that, about what you're doing. And the earlier versions of the question were very, very, very broad, to the point where if you even just bought and held, you were considered, you had to answer this question as yes. They have updated the question to make it a little bit more specific in terms of, are you transacting, are you selling, are you trading, swapping, and all that. So it's got a little bit more specific than the prior years. But in terms of what threshold, well, you want to be able to answer that question honestly. So we have to look at what they're doing and whether or not we have to answer that question. If we're answering that question as yes, then we have to look at the amounts. Now, from all practical purposes, if somebody's just has a few $100 in crypto and they're buying and selling and that's all they have and their account value really stays nothing, I would still probably report something, but I wouldn't track from just a practical standpoint. I probably wouldn't track the gains or loss really, really closely if someone's just dabbling. But I would probably tell them that we should put something on the tax return just to show that we did it. Brent, do you have any thoughts on that?
I mean, I'm afraid the IRS is listening in or something, so I don't want to say anything too crazy, but I mean, if you're only trading a couple $100, I'm hoping you're not trading that actively, to be honest with you, because there are a lot of transactional fees, and if you're paying 2.5% per trade or 1.5%, depending, you're probably going to be just nuking your return anyways. So I think you should report what needs to be reported at the end of the day. So
yeah, good question.
It's a safe answer right there.
I'm thinking of talking about your myths out there Brent, you mentioned the first one, that, hey, it's not taxable until it comes out of my Coinbase account or whatever. And another myth that I've heard is that, hey, I mine, there's a way to go out there and mine cryptocurrency. That's not taxable when I mine it. What do you say to that, Brent?
I would say that is incorrect, unfortunately. It's likely even self-employment income. It's income that you're earning through the trade or business. I think you're probably stuck there. So, yeah, no, unfortunately, when you have the right and dominion of control and ascension to wealth, you're kind of triggering an income event, and I think that would fall in that case. So,
yeah.
And
We'll get to your question. There's a good question out there, but I was going to say that kind of goes along the line with airdrops, right?
Yes, for airdrops, for those unfamiliar with that term, is when basically having an asset entitles you to something else getting dropped into your wallet or your account. Sometimes those can be additional tokens, sometimes those can be NFTs, depending. Whatever you receive in your wallet, that fair market value of that is taxable at that time. Same idea with giveaways. Sometimes you'll see people giving away ETH on Twitter or NFTs on Twitter. If you receive like a prize like that, that's fair market value of that in US dollars at that time that's taxable. So, hate to say it, congrats on winning, but I haven't won any of those things myself. But you do have a value of that prize to be included in your income for the year.
I will throw out there, Brent, and I completely agree with you, is that if there's not a readily tradable market for it, because there are times when people will drop new coin, airdrop a new token or an NFT that just there is no market for it. At that point, it's not taxable because there's no value and there's nothing to value it against. So I would, in that rare circumstance, I would throw that out there as an exception.
Yeah, no, I mean, if it's not a readily convertible, I don't think there's a value that it has. And some of those things are just rugs anyways, where a token gets released and it has no value or you can't access it. So, what do you do with that? Crypto IRAs is the question thrown out there. There are crypto IRA providers out there. I was recently hearing about one that does it kind of a trust setup. I forget the exact name of it, but there are certain ones that you can buy inside an IRA, which does make a lot of sense if you plan on transacting a lot, because of the deferral of the taxation until effectively you pull the money out of your IRA. So, yes, that is something that's out there. You just have to find the right provider for it.
Good. Then another question about hard forks, like the Bitcoin spinoff or Bitcoin Cash.
And Martin's really got some good questions today.
I know.
We've heard a little bit on hard forking. I'm not familiar with the way the transaction was written out, but if it's a spin-off and you receive part of your original basis back, there's a chance that that's not taxable. If it's just simply an incremental toss-out, you're probably picking up taxable income. So I believe actually we were talking about hard forks the other day. I just can't remember the exact ruling off the top of my head, but they did come out with something. So maybe hit me up offline. I'll see if I can get you some more guidance on that one.
Yeah. So, okay. What was I thinking? What were the other? Another common myth that we've heard is, because crypto is not denominated in the US dollar, it's not taxable.
Why don't you answer that one there, Kevin? I don't want
I'll
to answer
answer that one. That's not true. That's not false. That goes back to my first statement early on that, hey, for US tax purposes, all transactions need to be translated into US dollar. And that follows along the same line in terms of foreign currencies out there. So it's kind of that same principle of foreign currencies. If you sell a piece of real estate in Germany under the euro, you have to translate it back to the US dollar. So same type of thing.
So one of the other questions I get a lot, Kevin, is in regards to gas fees. For those that are unfamiliar with gas fees, they're effectively transactional cost, right? That you have to pay to get a transaction recorded on the blockchain. You have to pay a miner. Gas fees are not exactly a popular topic because they've been kind of expensive lately. How should we be treating those gas fees?
So when you are in what kind of situation?
When I'm buying and selling, I've got, so let's say I'm buying an NFT or I'm selling an NFT. How does that gas fee get incorporated into the cost?
That would be a selling or buying expense that would ultimately reduce either increase your basis to help reduce gain or increase loss depending if you had it. So it's a selling expense that would be used to offset the purchase the sales price. So, yeah. Another question that's come up, and it's unresolved. This one's particularly I find very interesting because I like to dabble. I don't say dabble, but I help in the international tax issues here at the firm. Is foreign reporting of cryptocurrency, and I will qualify this right up front that it is very unclear, and the IRS and FinCEN have not provided a lot of guidance on this. So for those who are aware, if you have foreign currency, a foreign bank account, we'll put it, that is in excess of 10,000 US dollars, you have to disclose that to the FinCEN and the IRS. They just want to know where your money is at. So the question is, hey, what about Bitcoin? What about these cryptocurrencies? So first of all, they have to be a foreign, under foreign custody, in a foreign account. Okay, and the interesting thing about this is for those who have wallets that are in the U.S., that's not an issue. So if you have a wallet in the U.S. on your computer or on your phone or whatever have you, or a cold wallet, those aren't issues here domestically. But if you're using, for example, a centralized exchange, for example, crypto.com, and Brent, if I'm not mistaken, that one's out of China, correct?
I think Hong Kong.
Yeah, Hong Kong. Okay. So the question is now, hey, that one is out of Hong Kong, is that obviously not in the U.S. And if I have a greater than $10,000 balance there, am I required to file? And as I mentioned, there is no clear guidance. So what do you do? Well, without clear guidance, what I would tell my client to do is, well, we should probably just report it because it's better to be safe than sorry. The penalties with failing to file these types of forms, this FBAR, we call it Form 114, is actually $10,000 or half the account value. And I would probably cross my T's and dot my I's and say, hey, let's just file it. It's not going to hurt. The IRS isn't going to come after you just because you file it, but it's better to be safe than sorry. Now, there is another form. It's Form 8938, and it's called a specified foreign financial assets. Okay. Now, this one is a different form, and it is only filed with the IRS. Okay. This form has a little bit higher threshold in that it has to be over 150,000. If I'm remembering correctly, there's a few different thresholds depending on where you live and such. If you're in the U.S. or out of the U.S., U.S. citizen and such. But the question then comes up is, hey, do I have to file this other form, this 8938, if I have, we'll call it $500,000 of cryptocurrency on my crypto.com account? Okay. Again, the IRS has not provided a lot of guidance on this, but I will also then take a more conservative approach and say, yes, I think you should file this form if you exceed the thresholds. Again, going to the point of it's better to be safe than sorry and to make these disclosures to the IRS. What the IRS does not like is that if you don't report it, and they think you should have, and you have to backtrack and explain why you haven't. So those are two interesting issues that are coming up that people don't know the answers to. None of us do, because the IRS hasn't provided sufficient guidance on it. On another note, which is interesting, in terms of this idea between cryptocurrency being property versus cash. Going back to that infrastructure bill that I talked about earlier that had passed at the end of the year, that in terms of the reporting, there was also another law, another portion of that, which impacts cryptocurrency. And it effectively said that digital assets such as cryptocurrencies valued at $10,000 or more are going to be now treated as cash received by any person engaged in a trade or business. Okay, so this is the first that we've gotten from Congress that would say, hey, it would need to be treated as cash, which is interesting because it's different than what has been the previous guidance by the IRS. Now, has anything been reconciled between these two? No, they haven't. So we're still in the dark. But it's important to look at it. Congress might be looking at this and saying, well, wait a minute, we might move towards this being treated as cash, which is interesting, which would then could theoretically impact the foreign reporting requirements that I just talked about. Now, the reason I bring this up is that one of the points of cryptocurrency is like, hey, I can transact business outside of the US dollar. And what this is saying is, okay, well, we're going to treat it as cash if it's over $10,000. And now there's a new reporting requirement. So if you're a business that has that takes these cryptocurrency and it's over $10,000, you have to report it to the IRS now. On certain forms, there's some forms out there that you have to report it. So that's again another interesting development. Now this one, like I said, has passed, and it's going to go into law, and that one I think takes place in 2023 as well. So, and one of the interesting things that I have seen about myself as I've gotten into crypto is the progression. And I'll admit, I started out in some of the meme coins out there, and then I've progressed into I would say the more stable coins, the more mainstream coins, Bitcoin, ETH, Solana, and such like those out there. But what I've also found out is that I am moving into the next realm, which is non-fungible tokens and NFTs. And it's the next area that I've progressed into and looking at and learning about. And so I think we're going to talk about that a little bit right now. Brent, you want to share your thoughts on that?
I'd love to talk about NFTs a little bit here and just the taxation behind them. There's a lot of misconceptions on how they work. And first off, not financial advice, right, Kevin, about what we're getting into. But, one of the things about NFTs is they're denominated primarily in terms of Ethereum, which we call ETH is kind of the street name. And so ETH is a floating value currency, right? It goes up, it goes down. And it creates kind of some interesting dynamics for when you're buying and selling NFTs. And so I'm going to use a few terms, kind of like old ETH and new ETH. What I mean by old ETH is that you had ETH from back in the day. New ETH is ETH you just bought right now. And so if you're buying an NFT, you might create a taxable transaction right there. And so Kevin kind of alluded to it in his examples before. If I had ETH that had a low value before, I use that ETH to buy an NFT, I've likely triggered a taxable event and likely a gain if my ETH was low at the time when I bought it, and it's a high value when I purchased it. Now, I could also trigger a loss as well if ETH had a higher value back in the day and a lower value at the time. So anytime you're buying and selling an NFT, you're likely creating a taxable transaction. It's unusual because a lot of times you think that you would be only doing transactions when you're selling them. And I think that's a really unique piece. When I buy a stock, I can't create a loss on that transaction, where if I buy an NFT, there's a chance that based on what Ethereum is doing in the current marketplace, that I could be triggering a loss. So, you might have opportunities for tax loss harvesting by making purchases, which is very unusual. Kevin also mentioned earlier when we were talking about swapping up. I think a lot of people will flip NFTs to get into another NFT, and they'll try to kind of grow into the next big club, 48 Yacht Club or whatever they're trying to get into. And so they're trying to kind of swap up. And every time they're doing it, transaction buy, transaction sell, And it's great if you do get to that next level of an NFT, but if you don't have any cash to pay your taxes at the end of the day, that's going to be kind of an interesting situation. So um, NFTs are just something that people don't understand that well when it comes to the tax applications of buying and selling them. So I think they're fascinating topics. There's tons of transactional costs you got to watch out for. Um, but I think really the unique piece is that you also get taxed on the buy potentially. And Kevin will probably tell me different if I buy ETH right away that same day, but just creates another level of record keeping to keep track of as you're tracking not only both the value of the NFT in Ethereum, but also what the value of that Ethereum was when you bought or sold it.
Yeah, I think another interesting aspect of the NFT space is the taxation to the creators of the NFTs. And they're receiving this ETH, and how is that taxed? And potentially self-employment income, because you're creating these pieces of art that you're selling. So that's an interesting aspect of it, along with the idea that with NFTs and the smart contracts, is that royalties can be paid to these creators for years to come. For every time that NFT is later sold to somebody else, a portion of that, it could be 7.5% or whatever, could go back to the creator. And again, this would be income to the creator of those NFTs. And depending on how it's set up, if we'll call it an individual, those royalties could be subject to self-employment tax as well as ordinary income and self-employment tax. So.
Yeah, if you're a developer of an NFT, you should definitely be looking at structuring your business a certain way. So, there's different avenues to go that are more appropriate. So some of these developers that are putting out these NFTs are actually making pretty serious money. And if you guys haven't talked to a tax counsel yet, you really should.
Martin has another great question about whether or not the collectibles tax rates applies to the sale of NFTs.
I think that's a great question, Martin, and one that's hotly debated right now. The question becomes, are they collectibles, which, is, paintings, gold, you get that definition out there. And at this point, we're effectively treating them like capital assets or intangibles has been what a lot of the community prescribes. Whether or not the IRS comes out someday and eventually says collectibles is an interesting conversation, and I think that's something that people need to be aware of. I think Kevin will make some better points than me about why he thinks it's a capital versus a collectible. I would just kind of throw out that in the NFT space, you have to hold it for a year to get capital gains treatment for it to matter. And the NFT space is so new that people usually aren't in them that long. So, I think that's great, but I think the odds of someone making it to a year are actually pretty low in the NFT cycle, is what it appears so far from what I've seen, with just the tendency for people to get in and out of projects. Kevin, why don't you kind of elaborate more on the collectible piece there?
Well, I did just want to say, in terms of my personal thinking, is that right now the IRS has not issued any guidance in this area. Of course, they're behind the 8 ball on this. And if I was advising my client and they did hold it for a year, without further guidance from the IRS, I'd probably just take the position it's not a collectible, and that it should be taxed at the regular long-term capital gains rates. You can make an argument for either side. I think that's beyond the scope of this presentation right now, but it's out there whether or not you want to do it, conservative, and how much you want to pay to the IRS. I think that's more their a decision that you have to make. But for me, I'm not really excited about giving the IRS more money than I need to any sooner than I have to. So again, great question, Martin. Great question on that. So.
Kevin, did you have any other questions that people have sent you, or any tax myths that?
I'm looking through. We talked about staking. Talked about mining airdrops. Like I said, I guess maybe from my perspective, kind of finish up how I started, in that generally just about anything you do in the cryptocurrency space, other than buying and holding, is going to be a taxable event. I will caveat that if you're just transferring between wallets, that's not going to be a taxable event. But then again, you're going to probably incur some expenses along the way, some gas fees and such. You want to be careful in that. But Brent also made a good point to me as we were talking about this. When you're transferring between wallets, some people have the tendency to exchange into different coins. You want to explain what you were sharing with me, Brent?
Sure, yeah. So, when you swap, you're creating a taxable transaction, even if you're kind of coming back to the same spot you were at before. So, ETH can be more expensive to transfer than like an XRP token is one that people will transfer it to, and then transfer it over to your wallet and transfer it back. And I mean, I think you're exchanging basically one token for another token. That's a value exchange, and so you're effectively stepping up your basis at that point. So, it might not be a big deal to, to create a taxable transaction there if you're just swapping around and it's just moving a little bit of money. But if you had a highly appreciated portfolio and you moved it over, you could be triggering some stuff there. So just as something else to watch out for. I mean, I think to Kevin's point, if it could be taxable, it probably is in this space. But there's obviously very poorly written guidance out there to this point. There's so many new kinds of products that are coming to the marketplace, and so many different ways that people are trying to skin the cat on this, because it is so decentralized and unregulated that it does just create a lot of questions. But if it looks and smells like income, it probably is.
Are there any other final questions before we wrap this up? I don't want to keep you here too late. Any final words, Brent, or suggestions?
I think we're so much in the first quarter at this point in this space that there's going to be a lot more to come, and whether it's positive or negative, there's, whether the space explodes and goes nuts or crashes and falls, we're still really early. And so, there's just a lot of stuff that's kind of to be determined. And, I think reporting will help the space. I think it's really interesting. I think the other little piece I had was just on, some people have credit card rewards. Are those taxable? I don't think they are. I think they're just rebates of the purchase price for what you bought. But no, I think that's about all I had for today. But if anyone has questions offline, we're happy to take those and answer those back. So.
Well, I'll just throw something out. My last closing thoughts. I'd say, if you are doing anything in this space, NFTs or crypto, make sure you fully disclose it to your CPA, whoever's doing your taxes. Just it's better to talk about it up front and what are the reporting requirements than coming back a year later and saying, hey, oh, I didn't tell you about this. Then you have potentially amended return you have to file and additional costs there. Just be upfront. I had, for example, one client who I did their 2020 taxes, and then a few months later he came back to me and said, hey, you know what? I've had like cryptocurrency transactions the last like 3 or 4 years. I'm like, oh, well, you never told us that. And so now we're looking at amended returns. I would also echo your comment about, hey, this is the first inning. It's first quarter, whatever you want to call it. I do find it extremely fascinating and interesting. From my perspective, I think they're going to have to figure out how to get these gas fees down to make it more mainstream, just kind of to make it more palpable for people. You look at credit card fees, and those are minuscule compared to what you're paying for some of these gas fees and such. So I throw that out there, and they got to work on the on and off ramps for transacting in these things. It's not always intuitive and it's not always straightforward, but it is fairly interesting. But there are barriers to entry for just, I would say, most people. So.
Yeah. All right. Well, doesn't look like we've got any more questions right now, but so just want to thank everybody for listening, for watching us. We'll have a presentation next month on name, image, and likeness for those that are interested in that space and hearing more about that. So but happy to have you guys here, and hope everybody has a great night. Thanks for coming.
Thank you.